Good afternoon, everyone, and thank you for joining us. You're attending the last in a three-part series of DBRS Morningstar ABS methodology webinars. Over the course of the last several days, we conducted one on venture debt and another on whole business securitizations, both of which are available for playback on the Bright Talk platform. Simply search on DBRS Morningstar and you will find our complete suite of webinars. Today, we are discussing Litigation Finance ABS. My name is Stephanie Mah. I'm a researcher in our structured finance group, and today I'm joined by my colleague, Haksun Kim, an SVP in DBRS Morningstar's US ABS group and the lead analyst for litigation finance securitizations. A few housekeeping items. Please feel free to type in any questions that you may have throughout the webinar. You should see a question mark on the bottom of your screen. You can click on it and type in your questions. We will address those questions at the end of the webinar. In addition, you should see a link to a published methodology piece by DBRS Morningstar titled Rating U.S. Structured Finance Transactions with a special appendix devoted to litigation finance. In terms of what we will be covering today, we will start with the basics and define what exactly consumer litigation finance is, along with a brief overview of the industry landscape. Then we will turn our discussion to the heart of the webinar, delving into DBRS Morningstar's methodology for litigation finance securitizations, examining our key credit considerations, along with variables that we consider during our cash flow analysis. Now let's get started. Haksun, let's start out with a brief overview of the consumer litigation finance sector, first with a mini primer.
Sure. Thank you, Stephanie. So consumer litigation finance is the provision of limited recourse funding to a litigant, attorney, or medical provider, and the repayment of which is really contingent on the outcome of a case, typically a personal injury claim, such as motor vehicle accidents, premises liability, slip and fall, and etc. So for example, you are involved in a motor vehicle accident or suffering injury at work or on a third-party premises, and you need to fund your daily expenses while unable to go to work, you apply for advance from one of these, specialty finance lenders in this consumer litigation finance space. And the advances, together with interest and any fees, are repaid from the monetary sum awarded to the plaintiff or the settlement. And, if the case is lost, no amounts are due. That's why I mentioned earlier that it's there's a limited recourse to the borrowers. And a litigant oftentimes seeks funding to cover near-term expenses while the claim is being processed. And attorneys and medical providers may seek short-term funding against their own receivables. And a little bit about the underwriting. So the underwriting of these originators is generally guided from an assessment by an attorney of the chances of success and likely payout. And the likelihood of success really depends on the merits of the case and precedent. And the payout depends on the nature of the damage suffered and jurisdiction or court-specific behaviors. And about the size, so advanced sizes vary, but generally a relatively small fraction of the expected award. And securitized advances that we have seen so far have been fairly homogeneous and granular.
Thank you. Maybe we can broaden that out a bit to look at what insights you might have on kind of the litigation finance industry overall, along with trends that you have observed in the sector.
Sure. So consumer litigation finance industry size is estimated to be about $1.4 billion and expected to continuously grow. And DBRS Morningstar has rated securitizations for two of the major originators, Libra Solutions and US Claims. And there are other major players in the industry, and they are Golden Pair Funding, Cortiga, Omni Glofin, and Preferred Capital Funding. And most of these companies have originated more than $100 million worth of litigation finance receivables to date. And DBRS Morningstar, as I mentioned earlier, has rated transactions for 2 of the major originators. And we have so far rated 10 securitizations in the space. And we have seen the receivables performing as expected. And we have seen some delays, of course, in collections at the peak of pandemic due to slowing of court processes and interactions between attorneys and insurers. But the collection velocity is really expected to recover near pre-pandemic levels this year, as the legal system is also expected to be fully operational, with cases that were backlogged during the pandemic being mostly resolved. But despite the slowed collections during the pandemic, we have seen the transactions that we have rated performing well by building credit enhancements as the notes have amortized.
Haksun, you mentioned that we've seen generally performance as expected, with these small hiccups, during the pandemic. But a few short hours ago, the Commerce Department released its latest economic figures, demonstrating a resilient fourth quarter, fueled in large part to strong consumer spending, with the U.S. economy expanding 2.9% on an annualized basis for the final quarter, which was slightly higher than economists' forecasts of 2.6%. But nonetheless, it still marks a slowdown from the 3.2% growth that we saw in the third quarter, likely a reflection of recent moves the Fed has taken thus far to reduce demand. Expectations have the Fed increasing rates yet again at its meeting next week, probably 25 bips. And with these recessionary pressures in mind, how do you see this affecting the litigation finance sector?
Right. I think we all feel and sees signs of a recession, but a limited impact is expected really in this asset class. Because there is relatively low correlation between the underlying quality of receivables or the borrower's ability to pay. Because as I mentioned earlier, the key here is really the strength of the underlying cases.
Okay, let's dovetail next into DBRS Morningstar's analytical approach to rating litigation finance, and this is really kind of the heart of our webinar, identifying what our key credit considerations are.
Sure. So here, DBRS Morningstar published the rating methodology for consumer litigation finance ABS. And the methodology really describes the key collateral performance drivers, assumptions used for such drivers, and related cash flow analysis. And just like other consumer assets, DBRS Morningstar considers quality of origination and servicing. So in origination quality, for example, we look for the experience of management, the underwriting processes, the size and experience of the compliance and legal team, ability to accurately forecast award amounts, and management of attorney firm panel and healthcare providers. In servicing quality, the servicing of these receivables is not as intensive as some of the other traditional consumer loans. And that's because the servicing is primarily consists in tracking the case status. However, servicing continuity is nonetheless examined, and so is the arrangement with a backup servicer. Other than these two, there are 3 additional key credit considerations when we analyze this asset class, and they are predictability of collection amount, financial strength of insurance companies, and potential legal risks. So firstly, predictability of collection amount, many times also referred as cash multiple, which is multiple of invested capital. So DBRS Morningstar pays attention to originator experience, controls, and underwriting policy, as stability in originations impacts the stability of cash collections across different origination vintages. And the issuers that we have issued ratings for have more than 10 years of historical collections data by different underlying legal cases. And the data really allows us to predict an expected cash multiple by case type. If fewer than 10 years of data are available, DBRS Morningstar may choose to use proxy data such as cash multiples and collection timing observed in the industry. Of course, to the extent there is sufficient data to establish the similarity between the collection pattern of the originator's receivables and such proxy data. Secondly, financial strength of insurance companies. The ultimate obligor is oftentimes an insurance company in this asset, and the claims payment will be originated from the insurance company. So despite a successful, settlement outcome, if the insurance company does not make timely claims payment, the collections can suffer, and obviously subsequently impacts the transaction negatively. And last but not least, potential legal risks. Given that litigation finance is relatively new asset class, legal and regulatory requirements adopted by states vary, with some states requiring originators to register with a state agency, limiting interest rate levels, or prescribing certain terms of the agreement, while others do not really have any legislation or regulation in place. There are various jurisdictions that prohibit purchasing claims from claimants and or assigning claims. And the relevant laws, regulations, and interpretations in these jurisdictions are subject to change at any time, and which can really lead to unfavorable outcome on pending cases. And so DBRS Morningstar really assesses if the originator has a system in place to diligently monitor the legality of funding agreements in each state in which it conducts litigation funding business. And for this reason, and for this level of uncertainty, DBRS Morningstar typically does not assign the highest rating levels to that of consumer litigation finance securitization.
Okay, so it sounds like we have kind of 5 key credit considerations. We have origination quality, servicing quality, the predictability of the collections, the financial strength of payment sources, and then lastly, potential legal risks. But I want to kind of switch gears a little bit, because what about on the cash flow side of things, Haksun? Are there specific assumptions that we incorporate into our rating analysis?
Sure. So the cash flow analysis consists of testing certain stress cash flow scenarios to establish whether the bonds in each scenario would be paid in accordance with the terms of a transaction. And so firstly, expected cash collections and collection timing. So DBRS Morningstar starts by establishing an expected collection vector based on the originator's historical collection pattern and the pool composition. And implicit in the expected vector is really an expected cash multiple, which I mentioned earlier. And the expected collection vector and cash multiple are then potentially qualitatively adjusted to reflect the trends in the originator's collection data or in the industry, and originator's expectations and any changes in originator underwriting practices, and also if data is available, DBRS Morningstar may segment the pool by claim type, geography, and etc., where the segments really when the segments display different behavior. And secondly, cash multiple variability. So DBRS Morningstar applies stresses to the expected case to reflect the variability of cash multiple. And the stresses are determined based on the originator's historical variability in collection, which is as measured by the coefficient of variation. So that's, in other words, the standard deviation of cash multiples across different vintages divided by the mean cash multiple. So this coefficient of variation is really translated into haircuts to be applied to the expected case via a log normal distribution. And the stresses resulting from such computation may be adjusted qualitatively to the extent the historical data is deemed not to fully reflect the potential variability, or where the pool exhibits concentrations either by claim type, geography, or some other segmentation. Thirdly, insurance carrier risk. So DBRS Morningstar uses its proprietary model called the DBRS Yellow Asset model to conduct its analysis and to estimate losses at different statistical confidence intervals that correspond to a given rating level. And the DBRS Yellow Asset model uses several key inputs, such as notional exposure calculated based on each insurance carrier's share of the pool, the insurance carrier's credit rating, or other opinion, or expected recovery, and correlation assumptions among the carriers. And expected recoveries are usually assumed to be in the 50% to 70% range. And typically, a single correlation factor is used across all the providers, as they are generally in the same industry, which is the insurance industry. And the loss levels generated by the DBRS Yellow Asset model at various rating levels then are applied to further reduce the stress cash flow vector.
Thank you for that very comprehensive overview on the cash flow assumptions.
Sure.
This concludes our prepared remarks for the webinar. Now we will open the discussion for Q&A. Again, you should see a question mark on the bottom of your screen, which you can click on and type out your question. Let's take a look and see if we have any. Okay, this first one, I think we already touched upon this earlier in the webinar. It talks about legal risks, but I think this question is asking about legal considerations in the transaction structure.
Sure. So DBRS Morningstar, when we assess a transaction, we require the legal structure and presence of legal opinions that address the true sale of the assets to the issuer and the non-consolidation of the SPV with the sponsor, and also are consistent with our legal criteria for U.S. structured finance, which is published on our website. So those are the things that we pay attention to, which is kind of consistent with how we view other SPV-based transactions in other asset classes.
Okay, let me just check. I think we have another one. Would your stresses be different than a granular pool with smaller ticket size and a less granular pool with a larger ticket size?
It really depends on the variability of cash multiples demonstrated in the historical collections performance data. However, I would think a less granular pool with a large ticket size would typically show higher variability as a larger ticket size means a higher proportion of the pool, given the same pool size. So yeah, therefore, maybe higher stress would likely be applied for more chunky pools.
Okay, I see another one. Thank you for being so engaging to our audience. Would DBRS be able to analyze a securitization backed by a pool litigation finance receivables to small businesses or corporations?
This methodology is really limited to analyzing a pool of litigation finance receivables to consumers, not really to corporations or small businesses. I'm unsure if in fact such pool would have historical collections performance data that would really allow us to be able to, accurately derive cash multiples. In other words, the likelihood of successful outcome for the relevant legal cases. So even if there will be such data and we were to apply this methodology, the pool will most likely be very chunky, and I think therefore the stresses to be applied might be just too onerous, and it might not make economic sense to do a securitization from the sponsor's perspective. And just to reiterate, this methodology is really for a rather granular pool of litigation finance receivables to consumers, where abundance of data is present for us to be able to derive assumptions.
Okay, thanks, Haksun. Let me see if we have any more. And again, to remind folks, you can just click on the question mark on the bottom of your screen, and you should be able to submit your questions in that fashion. Let me just check. Okay, I see another one that came in through. What organizations have been servicers and backup servicers in this space?
So primary servicers have really been the originators of the receivables. So for those securitizations that we have rated so far, Libra and U.S. claims, they have been the primary servicers, and the backup servicers for those two transactions are Computershare Trust Company. I think it's Wells Fargo used to be a servicer for some of the older litigation finance securitizations, but then they sold their corporate trust services arm to Computershare, and then I think that transaction must have occurred like March of 2021, if my memory serves correctly. So ever since then, the backup servicing duty has been performed by Computershare Trust Company. But other than that, because I can only speak to those transactions that we have rated so far, so that's pretty much how much I know.
Okay, thank you. Let me see, it's the last call for questions. Okay, this ends our Q&A session. Thank you for being, oh, do I see one more? I'm sorry. I think I saw one last question squeak in. Do all U.S. states allow for litigation finance?
Not really. So when I work with these originators, so there are only not few, more than a few, but then there are a limited number of states that allow such assignment of interest being transferred from the consumers to the borrowers to to the trust or SPVs. So not all, and there are certainly some states that do not allow this type of purchasing of this type of receivables into securitizations. And as far as I know, I think New York, and California and Texas, there and Nevada, a few states that are very friendly to this type of receivables. But again, there are some others who do not allow.
Okay, I think this really ends our Q&A session, but thank you to everyone for being such an engaging audience. We really appreciate that and taking time out of your day to join us. If for some reason we might have missed your question, please feel free to reach out to us. You see our contact details here. And of course, a special thank you to Haksun for sharing his invaluable insights on the litigation finance sector. This webinar is being recorded and will be available for playback should you wish to revisit any discussion points or perhaps even share the replay with your colleagues. Next week, we will start our Outlook webinar series on consumer ABS, followed by commercial ABS the subsequent week. Thank you again for joining us and have a great rest of your afternoon.